Suppose federal tax receipts rise after a tax cut. Does that prove the cut paid for itself? No. The Joint Committee on Taxation defines a proposal's revenue effect by comparing projected receipts under the proposal with projected receipts under present law. The comparison is not simply with the dollars collected last year. Receipts can increase because prices, wages, profits, and the overall economy are growing, while still coming in below the amount projected without the tax change. So two statements may be true at once. The Treasury collects more nominal dollars than before, and the tax cut produces a revenue loss relative to unchanged law. That distinction is the foundation of this debate. Evidence of rising receipts is relevant, but without the present law baseline, it cannot establish that growth replaced the revenue foregone because of the tax cut. Another common misunderstanding is that a conventional revenue estimate assumes people do nothing in response to a tax change. JCT says its estimates incorporate predicted behavioral responses, including changes in when income is received, when capital gains are realized, how businesses are organized, how investment and consumption are allocated, and how taxpayers plan around the law. What a conventional estimate generally holds fixed is the overall size of the economy. A macroeconomic, or dynamic, analysis adds possible changes in economy-wide output, employment, investment, and interest rates, and then estimates how those changes affect federal receipts. That means behavioral and dynamic are not synonyms. Ordinary taxpayer responses may already be in the conventional score. The additional question is whether the proposal changes the economy's total output enough to recover some or all of the remaining revenue loss. Public Law 115/97 was enacted on December 22, 2017. It was not a clean experiment involving one marginal tax rate. The law combined individual rate reductions with changes to deductions and credits. It permanently lowered the corporate income tax rate from 35% to 21% and made substantial changes to business and international taxation. That breadth matters when interpreting the results. Different provisions can affect work, saving, investment, tax planning, household income, and federal revenue in different ways. Some provisions may change marginal incentives more strongly than others. Some may chiefly increase after-tax income, and interactions among rates, deductions, credits, and business rules can change both the economic and distributional outcome. The official estimates therefore evaluate the package Congress enacted. They do not prove that every possible tax reduction would produce the same result. Before adding economy-wide growth feedback, CBO and JCT estimated that the 2017 conference agreement would reduce federal revenues by about $1.649 trillion during fiscal years 2018 through 2027. They also estimated that it would reduce federal outlays by about $194 billion. Combined, those changes increased the projected deficit by about $1.455 trillion over that budget window. This was a conventional budget estimate, but that does not mean it ignored tax planning or other ordinary behavioral responses. It means the estimate generally did not count a change in the overall size of the economy. The next analytical step was to ask whether stronger output, employment, or investment would generate additional receipts, and whether borrowing associated with the law would create offsetting interest costs. Keeping those stages separate prevents conventional costs, growth feedback, and debt service from being mixed into one ambiguous number. JCT's macroeconomic analysis, dated December 22, 2017, estimated that the law would raise average GDP by about 0.7% during the 2018 to 2027 budget window. In that analysis, economic growth recovered about $451 billion of a conventionally estimated $1.456 trillion revenue loss. Additional federal debt was also estimated to add about $66 billion in interest costs. The precise figures depend on the scope and accounting used in that analysis, so they should not be casually substituted for numbers from a different budget table. But the conclusion within JCT's own framework is clear. The estimated growth effect was substantial enough to reduce the cost, yet not enough to eliminate it. Even under that favorable GDP estimate, more than two-thirds of the conventional revenue loss remained unrecovered before the additional interest expense was counted. Growth feedback was real in the model, but full self-financing did not occur. CBO later revisited the law using a different period, 2018 through 2028, and updated economic projections. It estimated that the total deficit would increase by $2.314 trillion before macroeconomic feedback and by $1.854 trillion after feedback. The $461 billion feedback offset amounted to about 20% of the total deficit effect once debt service costs were included. These numbers should not be treated as a direct revision of every figure in JCT's earlier analysis. The budget window and projections differed. They do, however, point in the same broad direction. Macroeconomic feedback reduced the projected fiscal cost, but most of the cost remained. The debt service component matters because a tax package can expand the economy while also requiring more federal borrowing. Interest on that borrowing can absorb part of the additional revenue generated by stronger economic activity. The strongest good faith case for growth-oriented tax cuts is not that every cut automatically pays for itself. Lower marginal rates on work, investment, entrepreneurship, and mobile capital can improve incentives, reduce avoidance and inefficient tax planning, attract investment, and expand the long-run tax base. Official analyses recognize those mechanisms. They also distinguish short-run demand from long-run productive capacity. In the near term, tax cuts can raise consumption and demand, particularly when the economy has unused capacity. Longer-run results depend more on labor supply, saving, investment, productivity, international capital flows, interest rates, and the effects of rising federal debt. Supporters can reasonably question assumptions about taxpayer responsiveness, capital mobility, monetary policy, or crowding out, but uncertainty cuts both ways. A plausible mechanism does not by itself establish the size of the response, and faster output does not automatically mean enough additional revenue to cover a package's full conventional cost and associated interest. Treasury's 2006 dynamic analysis illustrates both the incentive-based argument and its limits. Its model projected larger long-run gains from reducing taxes on dividends, capital gains, and upper ordinary income rates than from provisions that mainly raised after-tax income without substantially changing marginal rates. Under Treasury's base assumptions, permanently extending the full 2001 and 2003 tax relief while eventually reducing government consumption raised long-run GNP by about 0.7%, but financing that same full extension through future income tax increases reduced long-run GNP by about 0.9%. This was a modeled comparison, not a forecast guaranteed to occur. Its lesson is that a tax cut cannot be evaluated independently of how the resulting fiscal gap is ultimately closed. Lower spending, higher future taxes, additional borrowing, and rising interest costs can produce very different long-run outcomes, even when the initial tax provisions are identical. On April 7, 2025, the Congressional Research Service reviewed the economic evidence surrounding the 2017 law. CRS reported that conventional macroeconomic models had originally projected the law to raise GDP by roughly 0.3% to 0.7% over 10 years. None of the models reviewed by CRS concluded that the law would fully pay for itself. CRS also assessed the post-enactment empirical literature, considered as a whole, that research did not demonstrate significant economy-wide effects, but CRS noted methodological uncertainty and the limited amount of research, so that findings should not be overstated as proof that every effect was zero. The careful conclusion is narrower. Neither the original models nor the later literature reviewed by CRS established full self-financing. Estimates remain sensitive to assumptions, identification methods, the time period studied, and the challenge of separating one law's effects from everything else happening in the economy. Self-financing and distribution are separate questions. JCT projected aggregate federal tax reductions in every reported income category for calendar year 2019 under the 2017 Conference Agreement. A later JCT review noted that the reduction in average tax rates generally increased with income. Those findings were specific to the law's mix of rates, deductions, credits, and business provisions, and the distributional table excluded estate and gift taxes. For any future claim, ask 4 questions. First, what is the present low revenue baseline? Second, does the estimate include ordinary taxpayer behavior, economy-wide growth feedback, and debt service costs? Third, is the claimed effect temporary demand or a durable increase in productive capacity? Fourth, which households and businesses receive the changes? Our center-left interpretation is that incentive effects should be counted, not dismissed, but across the broad packages examined by JCT, CBO, Treasury, and CRS, growth recovered only part of the fiscal cost. Full self-financing was not the normal official result.